So good morning. Let me first give you an overview about the IFRS9 implementation and overview about it. So IFRS9 is a comprehensive accounting standard that addresses the classification and measurement of financial assets. It made also impairment on the financial assets and hedging accounting. We focus mainly on three key aspects on the IFRS9. Which is the classification and measurement of the financial assets, in addition to the enhanced disclosure. And the end, we will focus on the ECL, the expected credit loss model. Let me begin by the classification and measurement of financial assets. As CGC Egypt introduced a more principle-based approach to classify and measure its financial instruments, as we have debt securities like treasury bills and time of deposits. Also, we classified our portfolio of guarantees. So this involves categorizing these instruments based on their cash flow characteristics and our company's business model. Excuse me, there is no... So our company needs to classify its financial assets into categories based on their characteristics. So, for example, we might categorize these assets based on ones we can plan to hold for a future or for a long time, and others that we will use to provide more guarantees. Secondly, we move to the enhanced disclosures, as the IFRS9 enhanced disclosure requirements to provide users of financial statements with a comprehensive and more accurate and relevant information about our company's financial position and financial performance and our risk exposure. So by aligning with the accounting treatment more closely with risk management practices, we has disclosed info about the related to the credit risk practices and methodologies applied, and including our objectives and our policies and processes to managing our credit risk. So one of the key aspects of IFRS9 and our main focus is the expected credit loss model. So this model requires entities, and especially our company in Egypt, to recognize losses based on expected credit loss, more than waiting to them to be happened or to be incurred. So instead of the last model using the backward-looking applied before in Egypt, where the impairment was recognized only when a loss event happened, this model requires a forward-looking approach, including historical data, current condition, and economic factors for the company and for the borrower. Let me talk about the classification of the guarantees in the company in Egypt. We have mainly two products: the individual guarantee product and the portfolio guarantee product. The individual guarantee product it's a product we review individually from providing from the bank all the data and info, and we have the ability to approve and reject them. And on the other side, we have a portfolio guarantee product, which is in a form of portfolio. It's tailored for a specific sector and for a specific purpose. So I will pass the floor now for Mostafa to talk in details about implementation of ECL in CGC Egypt.
Our CGC method aims to determine the many options used in evaluating the provision values for each grantee issued by company or investment owned. We classify this model by introducing key points for the application as follows. ORR, credit rating of the customer according to the restriction of the Central Bank of Egypt, ranging from 1 as the best rating to 10 as the worst rating. Performing grantee, grantee for which the issuer of the facility has not notified the company of a rating below standard, doubtful collection, or poor quality, ORR 8, 9, and 10. Non-performing grantee, grantees for which the issuer of the facility has notified the company of a rating below standard, doubtful collection, a poor quality, ORR 8, 9, and 10. Then we will move to stages. All financial instruments are categorized into 3 stages according to the credit performance of the instrument and the commitment of the issuer or beneficiary to fulfill their financial obligations. All grantee with an ORR from 1 to 6 are classified stage 1. All grantee with ORR 7 are classified as stage 2. All grantee with ORR 8 to 10 classified as stage 3. The ACL model requires estimating the probability of default and loss given default and exposure at default. So the ECL equation will be BD times LGD times AD times discount factor. Probability of default represent the likelihood that a borrower will default on the facility within a specific time frame. Exposure at default refer to the total exposure a lender has to a borrower at the time of default. Loss given default represent the proportion of the exposure that is expected to be lost in the event of default. Our portfolio consists of 2 main products. The first product is individual guarantee, which we review the cases individually. Portfolio guarantee, which we issue a portfolio of a sum of guarantee with a specific criteria. Calculate BD and LGD for individual guarantee product. First, we take into consideration the macroeconomic factors like GDP and unemployment rate. And also we use change in equity index, change in non-injury index, we change in proportion of downgrade. For performing guarantee issued under individual guarantee product, BD calculate according to S&P scorecard and the credit cycle overlay projection model. For performing guarantee, LGD calculate according to S&P scorecard. We establish a mapping between S&P and S&P scale and bank ORR to calculate BD because we don't have the full information for this product. And the LGD as a fixed rate is set at 45%. For non-performing guarantee, BD is set at 100% and LGD is set at 65%. Credit risk is one of the most significant risks that CGC faces, as it affects our profitability, solvency, and reputation, as we provide guarantee to borrowers, thereby assuming the risk of default on behalf of lender. By estimating ACL, CGC Egypt could identify potential credit loss in our portfolio of guaranteed facility and take suitable risk management actions to mitigate these losses, such as adjusting guarantee pricing or implementing stricter underwriting criteria. Estimating ACL helped CGC to calculate the amount of provision needed to cover potential losses on guarantee facilities. Egypt has been aligned its accounting standard with international best practice, including the IFRS9. Compliance with IFRS9 ensures that CGC Egypt meets regulatory requirements and enhance its credibility in the eye of regulators. CGC Egypt plays a vital role in supporting access to finance for small and medium-sized enterprises. Implementing IFRS 9 allow us to enhance our risk management practice by adopting a more forward-looking approach to assess and provision against credit losses. This ensures we have adequate reserves to cover potential losses from guarantee provided to borrowers. Help us build investor confidence in the CGC operations and financial health. Finally, IFRS 9 standard improves CGC's standing in the global financial market, although it opens doors to international lenders who prefer companies with transparent financial reporting, thereby expanding the company's access to capital for further growth and development. Now I will stop here and Karim will continue. Thank you.
So I will highlight some of the benefits, other benefits that Mostafa has just mentioned, which is in the helping of assessing the creditworthiness of our borrower. So we evaluate in CGC Egypt using the ACL model the creditworthiness and the likelihood of default by the borrowers. This by looking at factors like the financial history and industry and economic condition of the environment of the borrower, and also determine the appropriate guarantee terms with the estimation of the expected credit loss. And when we put it in mind, we can decide the appropriate terms for the guarantee fees and coverage, and also the coverage amount. And this helped us to have a balance between managing the risk and giving a competitive guarantee offer for the banks. Also, we have now a better planning. So by predicting potential losses upfront, our company set aside some provision and reserves to cover our unexpected losses and also the expected losses, and this helps us to move and to be more prepared financially and reduce the chances of the unexpected losses. Also, applying the ACL model improved our decision making with a clearer understanding of potential risk. So now we can make a better decision about think tank providing guarantees. They can also assess risks more accurately and take steps to minimize them. Now, after successfully implemented all the IFRS9 and ECL model, we faced some challenges, which is having a limited availability of historical data for our borrowers. And these challenges made a main problem for us to ensure the data quality. So we overcome this by investing in our data management infrastructure and data analytics. And now we were working on analyze all the relevant data for the borrowers, and also we enhanced the data processes to improve the integrity of the company. The lesson learned after applying the ECL model made us a clear view for how we calculate the expected credit losses and improved our financial reporting. Finally, we have invested in data management infrastructure and data analytics, and after implementing the IFRS9, we encourage the adoption of more sophisticated credit assessment practices and techniques, and this led us to continue monitoring and have a good validation of our portfolio. Thank you.
Thank you. Some questions?
En fait, j'ai une question par rapport à la gestion de la garantie en portefeuille. Très bien. Donc, ce que j'ai compris depuis votre présentation, c'est que vous avez normalement deux catégories de gestion de garantie. Il y a une garantie individuelle et une autre garantie, soi-disant, portefeuille. Pour la garantie individuelle, vous utilisez la grille de score de Standard & Poor's pour pouvoir estimer, pour pouvoir, en fin de compte, avoir la probabilité de défaut, en conséquence, calculer l'expected credit loss. Mais pour la partie de la garantie au portefeuille, comment vous estimez cette probabilité de défaut?
In the portfolio guarantee, we don't have the complete data for the clients, so we establish a mapping between S&P scale and bank ORR. This mapping is provide the BDs for any scale, any S&P scale. So we don't have to create a scorecard for portfolio guarantee, but we only use this mapping for calculate BDs. And about the LGD, we have a regulation about the LGD, and we set a fixed rate at 45%. Thank you.
So regarding the LGD, so the percent is fixed, is stuck. You don't use any model to calculate it.
Excuse me, can you repeat the question? You are asking about the LGD methodologies?
Yeah, exactly. So you said that it's 45%. So is it a fixed percentage without any calculation?
Yes, it's a set from a sheet provided by S&P based on the regulations in the entity. So we get also all the number from S&P directly. based on their calculation, not our data.
Okay, thank you. Yeah, I think that we should have invited someone from S&P to explain further, but perhaps for a next session. Any other question? No, thank you. So we are a bit late for time, but I think it was very interesting to have practical experience. So thank you very much, and thank you to Jordan too. Let's meet again after lunch at 2 p.m. Thank you.